Bitcoin probably didn't go up the way people would have wanted, but I do want to send kind of a message here. I heard a few podcasts this week with, let me say, macro people that I listen to often. There's not a lot of them still, but the ones I do listen to, they usually at least have a view on Bitcoin. All of them turn negative. And I think for the messaging side, we talked after the last Fed meeting, and I mentioned the fact that Powell has gradually, since really Jackson Hole, been working his way towards this position of labor versus inflation, but at the same time, the progression related to artificial intelligence. And I think this is an important time in history.
For the past decade and a half, software companies could grow almost independently of the real economy. They scaled without factories, without large labor forces, and without heavy capital investment. Margins expanded to 60 to 70%. Earnings growth became detached from physical constraints. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
As a macro person, this is an important point. So I am positive on small caps for next year. I am positive on commodities for next year. I am negative on the hyperscalers for next year. Well, that's the opposite of what's worked for clearly the last 3 years. But honestly, for the last 15 years, this has been a long software, short hardware trade. I can't say this loud enough to people. I can scream it from my window. I can do this in my YouTube video every week. We've reached the physical limits of software. So we've reached the point where we need to build out a lot of things to actually get the intelligence that we need from the data centers. And we have a bottleneck. So semiconductors are thought of as technology. That's hardware. These are chips, and they might be something that you can build, but they're not software. You don't snap your finger. You actually have to produce them. You have to go through this whole thing. We had companies that were able to grow without hiring people, and by having margins up at 60, 70% for 16 years that dominated not only the US market, but the global market. I like US foreign stocks over US stocks. I like emerging markets over US stocks, but that is not a call on US exceptionalism. It's not a bad thing. I think they're all going to go up together. But the problem is the US market cap, which is a momentum decision-making, who has won the last 17 years, is heavily geared towards things built on code. Oracle had their earnings this week. The earnings were good. I mean, there's nothing bad within there, but we've reached a bottleneck point. You can only say for so long, oh, we're going to get the revenue down the line. So this is one point that I'm going to make very clear in my weekend video for this week, which is Gavin Baker did an interview with Patrick O'Shaughnessy on Invest Like the Best. I've referenced one he did a little over a year ago, which I thought was fantastic. This one was also fantastic. There were so many nuggets in this. When I do my weekly video and I'm thinking about all the points to go, I think there were about 15 pages or 15 slides that I have solely from this interview. So I highly recommend people listen to it. But one of the points that he made was that over the last 18 months, the progress we've had in the models, so going from GPT-4 to GPT-5, was not based on Blackwell. It was not based on getting these chips, which are super important to having bigger intelligence. It was based on the advancements we made in reasoning, the advancements we made in reinforcement learning, the advancements we made in test time compute. These were all, let's say, efficiency gains that allowed us to get to this point. The reason that's important, those are basically software things. Those are not the hardware build out that we actually need for power and to get to the point where, as I've talked about before, VLMs, visual language models, can start to enter our world. That's where things like robotics, humanoids, or robotaxis, upgrade cycles to phones, to computers, all of that stuff is coming soon, but you can't get there without the Blackwell deployment. And even though Blackwell started being sold this year, the data centers have to be built. So in the first quarter of next year, it's expected that the next phase of Colossus will be done, which means we're going to start to see the benefits of Blackwell in a bigger level. You're going to see the robotaxi rollout. Elon Musk hinted that he still believes that before the end of this year, which means within the next 2 weeks, he will have no safety driver in a car in Austin. I still believe that's a massive event for Tesla. I love the chart of it. I believe we're entering the hardware side, and the hardware side means we need LIDAR. Go look at LIDAR stocks. They are beaten down like small caps. We already talked about Corning last week, which isn't a small cap company now, but before the rise came for optical fiber from their point, they were a mid cap company. They were below 30 billion before this rise. So I think you're going to see a lot of the Cornings of the world, a lot of the EOS of the world, the things we've talked about that so far this year have benefited. I think next year, it's a tide that lifts all boats, and this is why PMIs are important. If you don't know what a PMI is, we've talked about it. Go into your favorite LLM and just type in why are the PMIs important to the stock market with equities, because their reaction is what I'm expecting as a preview for next year. For the last couple months, I've talked about the fact that I think it's going to be a lot harder for tech to continue its let's say its dominance, specifically the Mag 7 and let's narrow it down, the hyperscalers, because I do believe that the hardware side of the economy is going to be fine next year, and that's Tesla and probably Apple as well. But what did work was clearly the things related to what I call the PMI surge. You've got small caps that went higher, transports ripped higher. You've got a lot of components with inside there related to a weaker dollar. You've got the CRB raw industrials metals index breaking out. You've got rates, long-term rates going higher with equities going higher. So you have kind of the perma bears on what bonds are doing. But the reality is we have this whole growth trade going on. So I think the Fed moving rates combined with the expectation that the first quarter is going to see the biggest stimulus part of the one big beautiful bill has people thinking that they should be leaning more towards cyclical pro-inflation related things. And that's the way the market worked out. At the same time, growth underperformed value. That has been kind of a mega trend that's gone on for the better part of this year. But Palantir's off the highs. I was saying NVIDIA's off the highs. You have a lot of these AI fear trades, OpenAI, all of the component pieces that are still there. So on the equity side, it was as expected.
Bitcoin hasn't rallied the way many expected, but that disappointment itself is notable. Several macro commentators turned bearish near recent lows, which Visser views as a contrarian signal. Key points: credit spreads are tight, liquidity is improving, reflation signals are rising. Ethereum's chart looks stronger than Bitcoin's. Visser believes Bitcoin is consolidating, not breaking down. If it reclaims key levels in the low 90s, he expects a surge back toward $100,000, with a potential return to all-time highs in Q1.
For Bitcoin, Bitcoin probably didn't go up the way people would have wanted, but I do want to send kind of a message here. I heard a few podcasts this week with, let me say, macro people that I listen to often. There's not a lot of them still, but the ones I do listen to, they usually at least have a view on Bitcoin. All of them turned negative. One of them I couldn't believe turned negative, but openly said turned negative 3 weeks ago, which I think was the low. If you look at the chart of Bitcoin, it's not a great looking chart. It fell very, very quickly. We've talked about a lot of the reasons why, but it is starting to act better here. And I do believe, and I've said this, that I've got a lot of buy signals on things that I have. I'm looking at a lot of things that say that if we can get above 93,000, I expect there to be kind of a surge back up to 100. If we can have 3 daily closes above 92, that would be good too. But Ethereum already has a good looking chart. You've already broken the downturn trend line. It's kind of outperformed Bitcoin on my stuff in terms of the relative chart relative to the beginning of the year. So I think right now, you've got credit spreads at all-time types. You've got the reflation trade going on. I strongly believe PMIs are going higher. And for me, that means that Bitcoin is just kind of, whether it stays here between 85 and 92 for another couple weeks, when we get into the beginning part of next year, I think we're going to see Bitcoin back above 100. And I think the surprise will be back to all-time highs in the first quarter. We had, the committee had worked our way up to 90+%. But I think there were a lot of nuances in this that are definitely important for markets. And I think for the messaging side, we talked after the last Fed meeting, and I mentioned the fact that Powell has gradually, since really Jackson Hole, been working his way towards this position of labor versus inflation, but at the same time, the progression related to artificial intelligence. And I think this is an important time in history where we've reached a point where, starting in really September through October and now with this most recent meeting, he has basically talked about artificial intelligence and the impact that it's having. Now, at this meeting, I think the most important point that he made was really the focus on the labor side. You and I have talked about the reality of the labor market being weak. Last week when we spoke, I highlighted the fact that 6 of the last 7 months, we've had negative job creation for small businesses, less than 50 employees in those small businesses. And I think the Fed has a dual mandate, but they also have to deal with the K-shaped economy. And the message that came out was, number one, he implied that the non-farm payroll numbers, the one that we pay so much attention to, are likely overstated by about 60,000 jobs. It's a big deal. He also talked about the expectations that inflation was coming down. He talked about the productivity being at the higher level, and the fact that we're really not at the AI adoption point yet. So if you put it all together, it was a dovish press conference, and it was a dovish message that came out. And Bloomberg Intelligence, which kind of goes through it with a fine-tooth comb and takes the statements that are more hawkish, more dovish, according to them, it was the most dovish press conference we've seen since 2021. So I think on the whole, when you just take the press conference part, it was dovish. But obviously the other announcement they made, which is important for everyone, is they acknowledged the fact, after saying QT was ending, they said they had to start making purchases. Bill purchases will be, starting at 40 billion and likely be around that number until we get through the tax day in April. And so the need, again, of the Fed to be assisting the market on the funding side, and the need with this debt and deficit at these levels, has become apparent. And so for anyone who wanted to see gold, Bitcoin, the story of kind of the Fed being there to provide liquidity, they got a little bit of everything they wanted on this. And we don't have another cut built in until April to June. But I think for the time being, it was a positive, dovish meeting for everyone who was hoping so.
Now, one of the things I took away is that Jeff Park had this great tweet of they couldn't even make it to January. They could not make it to the end of the year before they had to start buying these treasuries. Do you put any weight on 40 billion, the fact that they had to do it so quickly within weeks of ending QT? Or is that actually what we should have expected? They just didn't telegraph it as much.
Yeah, so I think there's two components, and we tend to forget this stuff. But remember that the government was shut down for a long time leading into this. So I think there's two messages out of that. One is they didn't want to do anything or be involved in anything while the shutdown was going on unless they had to. The funding stress had been showing up. And even though I think they were confident, which most people that follow the Fed were, that the facilities that are open would always enable this to not be a big problem. But I think once you got through the shutdown, two things stand out. Number one, they gave the most dovish press conference in 4 years without having any real new data. I think that should be a statement in itself. And I do think the fact that they brought up the purchases to now just highlights the fact that this is a scenario that why wait until January when they're in a position that they should get this rolling, and the funding stress had been there. So I think there was a legitimate reason to kind of do it now and not have to wait till January.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.